Hello everybody. Now this chapter number 12 out of all my chapters that I have here, out of 27 chapters. Now this chapter is the only chapter I did not type in any single notes. It's not my materials. Is that okay? Why is that so? Is because this chapter appeared in your articles, AP4, then now AFM, September 2011. And this article was actually written by your examiner. Yeah, was written by your examiner. Of course, at the end of the chapter, those days they quote the examiner's name. Today, for some reason, we're not supposed to tell out the name of the examiner as well as the examining team. By the way, my name is Ovian, and I'm going to use this chapter to explain two things. Is that okay? I'm going to use this chapter to explain two things. One is actually going to be bond valuation, and another will be bond yield. And this chapter has come out many times in your past exam questions since the day it was published, September 11 article, and it has come out numerous times. Is that okay? Numerous times. And when do you need to use this valuation? Ask yourself in what type of situation you need to have a value of debt. Well, you need to have a value of debt in the weighted cost of capital calculations. Probably you need to have to calculate a cost of capital, maybe. Is that okay? You need to have probably to calculate value of debt, maybe for a gearing ratio. Is that okay? Using market value basis, which usually you have a choice of using book value, or you can a choice of using market value. You need to use, this is for the gearing ratios. Is that okay? Probably you need to do a valuation of debt in order for you to subtract from free cash flows to the firm. Remember, free cash flows to the firm minus the value of debt, valuation using free cash flows to the firm minus the value of debt, you're going to get the value of equity. Is that okay? So probably all that you need to probably get the value of the debt. Okay, so this is probably in other areas where they'll probably ask you to find the value of debt. So basically, this chapter is all about valuation of debt as well as bond yield. Bond yield is actually basically the yield to maturity. Usually, it's the yield for the investors, and we need this for maybe we may need the yield in order for us to do the valuation of the debt. Is that okay? So valuation of the debt. So you must know where the yield comes from, so that you can get the value. So it's basically interrelated. Yield and valuation are interrelated. You need value. To do value, you need the yield. To do the yield, you need the value. So basically, sometimes they're interrelated. So we'll see how it goes here in this chapter. And probably you need the yield for cost of debt computation for the cost of capital. So all that will be important. Okay, so basically what are we going to do in this chapter? There are 5 beautiful examples written by your examiner. All right, so we are going to just use that 5 examples to explain bond valuation and bond yield. I will probably add on using one more example just to tie up everything in order. Okay, so bond yield and valuation and bond yield. The first example, of course, you can read all this beautifully written here. Please read up all these things. What is plain vanilla bond and all that? Yeah, make sure you know what is all that. Okay, what is most important, I feel, direct to the point. Let's go direct to the point. Is bond value or bond price. Okay, bond value or bond price. So what is bond value or bond price? It's actually valuation of the bond. Now, the price of the bond, you must remember this. Usually the bond has got a date of maturity. Okay, usually all bonds have got dated. All bonds are dated. So the price equals to present value of future cash flows related to the bond. And there are two cash flows as an investor that you will receive when you invest in a bond, or as a company you will pay two cash flows as when you receive the investment from an investor. So basically the cash flows for the bond based on this cash flows will be interest. That will be a stream of interest. Year 1 maybe you're going to pay interest, year 2 you're going to pay interest. Now here we assume in AFM interests are payable annually. Is that okay? But in most cases in practice it's payable semi-annual. But in your exam, we will assume all bonds are dated at the payment is at the end. So its interest is going to be end of the year. We're going to receive interest for investor point of view. And also at the end of the last day, this is a stream of interest, maybe year 1 to year X or whatever, or let's say year Y or year 5, maybe 5 years. And redemption value, which is going to be your last day, you're going to get back your capital amount, so that it will be redemption value. So sometimes the questions will say redemption at what? Most of the time it will be redemption at par, but lately your examiner is changing it to redemption at a premium of say 5% or 8%. I think we can go about that, easily calculate that one. Now this example, we're going to see how much would an investor pay to purchase the bond today. How much would you pay to purchase the bond today, which is redeemable in 4 years for its par value or face value of 100, pays an annual coupon of 5% on the par value. The required rate of return or yield for the bond in this risk class is 4%. So there are a few things we need. The present value, I forgot to tell you just now, the present value is where you need a discount factor. To discount factor all these cash flows, this discount factor must be yield. And you must remember, for a bond valuation, all the computation is done before tax. Is that okay? Before tax, i.e. do not 1 minus tax. Is that okay? Don't ever think about 1 minus tax, because we are going to do the valuation before 1 minus tax, and it will be the discount factor is the yield, and this yield is the return to the investor. And remember again, this yield must be a before tax yield. Is that okay? It must be a before tax yield, and the cash flows here all, it is before tax. Even if I put here, let's say for example, if I put here tax is say 30%, for this bond valuation question, you can just simply ignore this. So how much would an investor pay to purchase a bond today, which is redeemable in 4 years for its par value or face value of 100, and pays an annual coupon of 5% on the par value? The required rate of return or yield for the bond in this risk class is 4%. So what I'm going to do here is, this is going to be in a CBE examination now onwards. Is that okay? So basically we're going to use this in the CBE platform. Of course the answers are all here. This is done assuming you are doing on a paper base. This is how you would do on a paper base, but how you feel that in a practice platform, we're going to see that here. So what we have here is 5%. 5% is the coupon interest rate. Remember, it's always on par value. And this is redemption is at par. Can you underline that? Redemption is at par in 4 years time. So there is a year 4, and the redemption is at par, so it's going to be 100, and the cash flows that you will receive as an investor, it is going to be coupon rate of 5%. So it is going to be $5 interest that we are going to get. So how do you go into this platform? So I believe you know how to use the platform. Just choose any blank workspace. Is that okay? And just push it here. And we're going to see this is going to be example number 1. This is going to be bond valuation. Is that okay? Example number 1. So we're going to have here bond valuation. Is that okay? Bond valuation. It's going to be the present value of future cash flows. So what we're going to have here, we're going to have here year. Now for valuation of the bond is at year 1. Sorry, it's at year 0. So we don't have any cash flows at year 0. So I'll just put here year 0 just for fun of it. Year 0, 1, 2, 3, and 4. You can do horizontal method or you can do vertical method. Let me just use this method here. So to draw the line, just choose one of these and you go ahead. You got the line already. Maybe this one you want to centralize this. Is that okay? So next what we're going to have here is you're going to have all your cash flows related to this bond. So we're going to have here cash flows. There are 2 cash flows. One is called the interest, which is, this is done per 100. Is that okay? This is bond valuation. This is done per $100 nominal value. Okay, this is done per nominal. Spelling error, it's okay in exam. Nominal, okay. Nominal, okay. Per 100. Try to format it if you can. No marks for formatting. Is that okay? No marks for formatting. So you're going to have here interest, which is going to be 5% on 100 because we are working a valuation for 100. So 5% on 100. So coming back here, it will be $5. You don't have to type that out into the cell to show the markers how you got the 5. I think you can smell that figure. So this one will be copied all the way. Yeah, will be copied all the way here. Okay, and what you're going to do is just centralize this. Okay, we're going to get this figure into adding on the redemption value, which is 100, and there you go. You're going to get here 105. Now obviously there is a yield given here. Now that yield, it's given in what do you call that, in 1 yield. Is that okay? There's a 1 yield here. If I put here tax, don't worry. As I said, don't worry. We're not going to use the 5%. $5 multiplied by 1 minus. No need to do that. Is that okay? If I give you the yield in 4%, what you have a choice of doing is you can ignore the discounting year by year. We are going to use it as cost of debt. What are we going to do here? We're going to have this present value of the cash flows. In other words, we're going to have here straight away the price of the bond. The price of the bond, which is using the functionality that is in the spreadsheet functionality, PV function. Is that okay? PV function. We're going to use a PV function here. So that's it. It's equals to, it's equals to, you are going to put here NPV. Doesn't matter whether it's a lowercase or uppercase. All right, in bracket. And you are going to type in the discount factor, which is your yield is at 4%. So you put here 4%. You can put 4% or you can put 0.04, up to you, doesn't matter. You put a comma there and you're going to drag all this figure. Actually, this function works from year 1 until whatever figure, whatever the year that you want. You can close the bracket option. If you don't want to close the bracket, just press enter, will do. And if you want to tidy up this answer in 2 decimal place, go ahead. Yeah, go ahead, you can do it this way, and there you go. So this is the price of the bond using the NPV function, and you will get full mark for this. I think you should get full mark for that. I think you should full mark for this. Okay, so this is the valuation of debt. Today, as we speak, you don't have to do the discounting if you don't want to do. But then I have to also teach you how to get about that discounting. Okay, so let's assume that you don't want to do this method. Okay, let's assume I'm giving you the alternative method. What we do now is we're just going to copy this and we're just going to paste it here, and we're going to paste it here. Is that okay? Yeah. So what are we going to do? I mean, the format painter doesn't work. It is platform, but in exam it works perfectly. So make sure you know how to use it to save your time on drawing the lines. So we're going to have here discount factor at say this is going to be at 4%, which is going to be the yield, which is going to be 4%. And the 4% that is given in this question or the article here. So how do you get the 4%? Is 1.04. Is that okay? 1.04. Exactly what the examiner did. Yeah, he's doing the same thing what the CBE platform we would also do. To the power of negative, choose this one. Don't type the 1. Okay, choose this one. To the power, oops, must put equals to first. Okay, so to the power, oops, I didn't put the power of negative. What am I doing? Okay, so equals to, come here to the power of 1, enter, and of course it's a bit messy here. Now, just drag. Sometimes it's difficult to drag in the platform. Now you can submit this answer, but it's horrible. You yourself can't see what the hell you have. Sorry, what did you do? So what you do is maybe you can choose this to 2 decimal places. At the moment, yeah, at the moment the number, there's no decimals here. But in a platform, it should be able to work out to 3 decimals. But it's okay if you can't show in 3 decimals. Just put in 2 decimals will do. Yeah. And what are you going to do here? It's going. No point you type. Don't look at this. Don't waste your time looking at this formula sheet here and type out the answers. No point. No point you transfer all these figures inside there. Just use this and yeah, just take this multiplied by this will do big U. Yeah. What am I doing here? Okay, sorry about that. Just get rid of all this. Oh, yeah. Okay. Tell you one more time. Let's get this out. Okay, this equals to this multiplied by this, enter, and you copy. You can copy and paste, or you just drag like this. Don't submit. You can submit like this. Is that okay? You can submit like this. Yeah, but you yourself can't figure out what it is. So better do some cleaning up. Yeah, it's not even. It won't take a long time, isn't it? You want to put in 2 decimals, valuation of debt, 2 decimals, go ahead. And there you go. The price of the bond. Price of the bond. I'm not using the functionality. I can put it here, I can put it here. Let me write it here. Is equals to the sum of the present value of the future cash flows, which is going to be, put it into this manner. So this is going to be 103.63. Same answer. It's a little bit of time, but you need to know this simply because sometimes the yield is not in constant at 4%. It might not be yield to maturity. They might give you some other annual yield. So this is the answer for this, which is exactly what the examiner have done. 103.62. Probably he has used the Excel spreadsheet those days. Yeah, getting ready for CBE practice. So this is what he got, 4.81. There you go. And mathematically, it's there. If the required rate of return is 6%, how would the answer be different? What will happen if it's 6? Same question. So what will happen if it is 6%? You see what happened? The price in this case, think about it. The price in this case, par, everything is at par. Everything is par. The redemption is at par. Everything. Now, yield means what the market is going to give you. What the market is going to give you. Market gives you 4%. You look at this company, it has got an interest coupon of 5%. So if it is going to be 5%, market gives you 4% on every $100 that you invest in the market. And if you invest here, okay, everything is at par here, so not a problem. So if you invest here, you're going to get $5 compared to if you invest in the market, you only get $4. Logic tells us that this will be in demand. Everybody will rush to buy this particular coupon bond, which is at 5%. And our logic tells us the price should start to go up more than its par value, because if it's at $100, everybody come and buy, and if it's 5%, everybody going to get 5%. Nobody can beat the market in the long term. Is that okay? No one can beat the market in the long term. So what will happen is the price will start to go up. It will go up to an extent that it will stop at that one point, and you will feel that you are going to get the return at 4%. So new investors coming in when the price starts to go up to, so if you are new and if you miss the boat, yeah, you're the last person who heard the news that this company is giving 5% coupon, and you rush to the market to buy. That time the price is 103.62. When you invest this amount, and when you get $5, $5, and $105, is actually you're getting a 4% return. That is what it meant here. It means here. Is that okay? This is what it means. So if the other hand, if the yield is 6%, market is giving 6, but you are giving 5, no one will look at you. Everybody will start to run to the market to invest. All will abandon this ship and run to the market. Is that okay? Run to the market to invest and get 6% return. So what will happen to this particular bond price? If it's quoted at $100, it will start to fall because the demand for this bond, put it this way, is not there. Everybody running to the market because it's giving 6. So what happens? The price will fall to attract you to keep looking there what's happening. While you're running here, you're also looking at there, and you're going to see the price will start to fall and fall and fall. And once you fall to a level and a return that you feel when you buy it cheap, and you still get 5%, and $5, sorry, if you can get $5 per every 100, you will feel that the return is now going to go up because you're buying it cheap. Return on investment. If your investment is cheap, your return is still at 5, you will feel that you're getting 6%. This is what I mean by here. So this is what you got here. Sorry, this is your examiner's name. All right, so here we got here, we're going to do the same valuation at same valuation here, which is going to be done. Okay, what we're going to do, we're going to copy this. Just going to paste it here. Now the yield is 6%. So what happens if it's 6%? Everything, we're just going to change this to 6% and enter and drag this to here. It will automatically change to 96.53. This one, we change this to 6%. And what happens? Enter. You should get the same answer here, 96.53. So basically, if the coupon goes up, okay, the coupon goes up, what happens here? That the demand for, sorry, not the coupon, the yield goes up. When the yield goes up, what happens? The price will start to fall down. Looks like it's an inverse relationship. Yeah, it looks like there is an inverse relationship here. So pay attention to this. All right, so that is what you got here. Now, put it this way. Let me explain to you in another way. If you ask me, I want to find what's the yield. Now let's paste it here. I'll put the price here. Let me put the price here at 96. I just put the exact price here. Okay, I put the exact price here. All right, let's round up to 0 decimal place. And I'll work this out in the investor perspective. Investor perspective means you are going to, let's just put it this way, custom. Yeah, sorry about that. All right, let's go to here. Let's choose this, 2 decimal. 2 decimal, yeah, this one. Okay, 96.53 is what you are an investor. You are an investor, you are going to pay 96.53, and you are an investor and you're going to get $5, $5, $5, and $105. What is the yield that you're getting? The yield that you're getting, we will use the IRR function. Yeah, remember, IRR function, which is using the function FUNCTION. So just to let markers know that you are using the function so that they won't miss out on that thing. So we're going to have here equals to IRR, open the bracket, and there you go. You just drag this and enter. Well, in percentage, it's, let's say, 1 decimal is giving you 6%. So that is what it means here. If you invest so much to get $5, $5, $5, $5, and another $100 is equivalent to you're getting 6% per annum every year. So the other way around. Is that okay? So this is what we got here. And then what we're going to do is we're going to do another calculation. This is per the next page of the article. Yeah, it is, if it's going to be 5%. If it's at 5%, coupon is 5, the yield is also 5 equals, so if the yield, just remember this, okay? In exam, just remember this, don't waste your time calculating. If the yield equals to coupon and the redemption value is at par, okay, if the redemption value is at par, then the price will be guaranteed to be at a par value. Is that okay? It will be at par, whatever, $100 or whatever par that is given in the question. So because it's, no one will run, because if I'm going to give you 5, the market gives you 5, why should I go to the market or come to you? It doesn't matter. So the price here will usually be quoted at par as well, if the coupon and the market is at par. That is what usually, when most of the time, you will feel that the company wants to raise $100. They want to raise money and they want to issue at par. So if you want to issue, there are some questions. I just want you to watch out for some questions like this. If they want to get the $100, they want to issue a loan for $100 and they want to make sure that they receive the $100. So what is the coupon they should set? Usually the coupon they set at the yield at the moment, then only they can get $100 issued for $100. Yeah, you understand what I'm saying? So there are questions that in exam since December 2010. We don't want to talk prior to December 2010 because this examiner came in December 2010. He's still in the examining team. Yeah, he's the examiner, and so basically what we're going to do is we're just going to look at questions after December 2010. There are questions tested. How much? That's one question I can recall. That how much? What is the coupon should be if I want to issue this at par of $100? Okay, so that is it. That's it here. $100, $100. So basically, let's try this. Let's just make it a point to prove. So if I'm going to change this yield to say 5% and happens to be at 5 or so, this one also I change at 5%. That's the beauty of this CBE platform. You don't have to redo the computations or whatever again. Can you notice the answer here? How come this is, oh, this one I haven't changed to 5%. So I put 5. Maybe you want to put 0.0. Let's try 0.05. It's the same thing, okay? Hey, something is wrong here. Sorry. here, if it's 0.05, you don't put the percent, I think so. Yeah? Yeah? Careful, huh? If it's 5%, if it's 5, yeah, okay. If it's 5%, you put 5%. It works. But if you don't want to put percent, then you put 0.05. Okay, careful, yeah, because if you put 5% by mistake, they simply put here 5%, and you're going to get an answer, but it's not the answer. Is that okay? So careful. It's always safe to put 5%. Is that okay? There you go. I hope you learned something from this. All right, so this is what I got here for, what did I do? Okay. Yeah, this is the valuation and of when the thing changes. Okay, so coming back here. So this is actually example number 1. Yeah, this is example number 1 of this article. So what do we learn here today? We learn here today the price of the bond is the present value of future cash flows. So present value is here 0, and I don't know what is here 0, that's the price. So when you are calculating here, if you notice, you don't even need a year 0 because you don't have a price, so you only need to know what are the cash flows coming in the future. Fastest way is doing this way, but you should also know this way because sometimes the yield is not constant annually. Is that okay? This is the one yield to the maturity, yield to maturity. But if it's not the same, then you need to do this way. But just pre-practice. You can do both ways. You can put in bond valuation, put in the word function just to let the marking team know that you are actually using the function, because sometimes they might miss out on how you got that figure. Okay, so this is what you got here. So this is going to be yield IRR figure. And there you go. Now, that's it. That's it for example 1. But to summarize this from example 1, what can we see here? We have a chart here, bond price and the yield. Now, bond price and the yield, it's going to be like this. Behavior, they behave like this. When the yield goes up to say 6%, the price will go down to this level. When the yield goes down to 4%, the price will start to go up. Is that okay? So when the yield is low, the price is high. When the yield is high, the price is low. Yield means not coupon. Yield means what the market is giving. The market is giving 6 and you are not giving 6, you are giving a low yield, so your price will go down so that the investor will still get the high yield because they are investing at a low price. So that's how it works out here. Of course, you can read all these things. That's how we end this question, example number 1. We're going to break this up into 5 parts here. So please watch out for this part 2 in the next recordings. Is that okay? So all the best to you. Take care, and hope to see you in example number 2 in the next video. Thank you, and take care.